Welcome to today's episode of Heard and Seen Around. I am Rajesh Karipurath. This is my take on macroeconomic and geoeconomic data points, which I find interesting. I hope you enjoy watching it as much as I enjoyed curating it. Cheers.
Let's take this offline. Translation, same conversation, fewer witnesses. The single biggest problem in communication is the illusion that it has taken place. If you put the federal government in charge of the Sahara Desert, in 5 years there'd be a shortage of sand. The definition of insanity is doing the same thing over and over and expecting different results. Some cause happiness wherever they go, others whenever they go.
US interest payments just hit $1.27 trillion a year over the last 12 months. And Washington gets absolutely nothing shiny for it. No bridges, no missiles, no hospitals, just interest. At this pace, debt servicing could soon become the largest item in the US federal budget, overtaking Social Security. That's what happens when trillions borrowed at near zero rates get refinanced in a world where money suddenly has a price again. The scary part, every rise in bond yields now acts like a tax on the US government itself. America still has a dollar privilege, but even reserve currencies don't do math forever. Nvidia just added $900 billion in market value in 7 trading sessions. That's larger than the entire stock market of many developed countries, created in about a week. The company is now flirting with a $6 trillion valuation, which basically means AI enthusiasm has now entered its money printer with graphic cards phase. What's remarkable in this rally isn't just about chips anymore. Nvidia has become the global macro trade, powering AI, data centers, sovereign tech ambitions, and every CEO suddenly inserting AI transformation into earnings calls. Central banks are now quietly changing the global financial playlist. Fewer US Treasuries, more gold bars. Since 2015, the share of gold in foreign reserves has jumped from 6% to 21%, while US Treasuries fell from 34% to 22%. The two lines are now almost shaking hands. This does not mean the dollar is collapsing tomorrow, but it does mean central banks are hedging against sanctions, debt explosions, and a world getting geopolitically noisier by the quarter. Gold suddenly looks less like a barbarous relic and more like the only asset that doesn't need a password, Swift code, or a treasury secretary. While emerging markets were sprinting higher, India's market seems to have dropped to admire its own valuation multiples in the mirror. Since the September 2024 peak, the MSCI Emerging Markets Index is up 57%, while the Nifty TRI in dollar terms is down 10%. That's an eye-watering 67% performance gap, something almost never seen at this scale. The message from global investors is brutal but simple. India remains a great long-term story, but its expensive valuation and slowing earnings, capital went bargain hunting elsewhere, especially China, commodities, and beaten-down emerging markets. Turns out structural growth story sounds less exciting when everyone else is suddenly cheap. After years of sitting in the economic waiting room, Indian industrial credit growth is finally waking up. Loans to industry just hit 16.4% growth year-on-year, the strongest pace since 2014. That matters because healthy economies usually borrow to build factories, expand capacity, and hire people, and not just to buy phones on EMI. Services credit is also humming at 17.4%, agriculture at 15.7%, and even personal loans are showing signs of life after regulators applied the brakes last year. In short, India's credit cycle is starting to look broader and healthier, less buy now, panic later, and more real economic activity. Turns out globalization has a leaderboard, and container shipping is basically an oligopoly floating on seawater. By 2026, MSC alone controls 21.5% of the world's container shipping fleet, ahead of Maersk, CMA, CGM, COSCO, and others. The top few giants now dominate global trade flows, freight pricing, and supply chain power, which means when shipping rates jump, ports clog, or geopolitics gets messy, a handful of companies can end up influencing inflation faster than some central banks. Also remarkable, Europe still dominates the seas, and China keeps expanding through COSCO.